but you've got an avatar. You've got a picture of a person that you could replicate in other cities, in other places, on other bases, wherever these people are hanging out. And maybe what you need to do is launch an educational campaign, not a sales campaign that requires a 506C, but an educational campaign to teach these people about some of the different techniques that maybe that they can use to invest in different types of deals. And so when you're providing this investment advice to these people, not investment what to buy, but how to maybe increase your wealth or how to be involved in real estate. That's kind of maybe what you got to do. Maybe you have to start planting some seeds in some other places and start developing some routines with some other people. You don't want to go there and sell. You want to go there and provide value. And you want to, it's kind of a long-term play. But if this is an avatar that you like because they trust you, then, I guarantee you can make a lot of dough from that vertical. I mean, it's a great vertical and it would be a natural place for you.
You're listening to the Guerrilla State Investing Podcast. We're not here to bruise your bananas with guru sales pitches, overrated fluff, or any other kind of monkey business. We simply provide the ground-pounding truth about what it takes to be successful in real estate.
All right, today's guest is Joel Block out of Agora Hills, California. Joel is the CEO of Bullseye Capital, a fund manager for distressed assets. He's also a keynote speaker, and the man wears an eye patch. Joel, how you doing today, brother?
Hey, man, I'm doing all right. So you're pretty into that eye patch, huh?
Yeah, I like that eye patch. I had to put it out there for the people listening on the radio, so they can't see it on the YouTube. But
it's kind of a new thing. It's a couple of years. I just woke up one day and bam, lost my vision. It just and it happens to some guys. I had a bunch of surgeries, a detached retina. They say my eyes healthy, looks fine, but I see double, and so the patch kind of helps me not see double. So it's but it says Dodgers on it. When I go to Dodger Stadium, they always put me on Dodger Vision because they just think it's the coolest thing going.
Yeah, it's pretty badass. I'm not gonna lie, I like it. Well, Joel, so I hit the wave tops of introducing you, but why don't you go ahead and tell us what it is you do, how you got started, and how'd you get to where you are today?
Well, listen, I do a couple different things, but I've been in the business of running a fund for quite a long time. I've been in the venture capital and the hedge fund business for really my whole career. I started as a CPA as a youngster at Price Waterhouse, the giant firm, and I was doing tax work. I was doing the tax returns for 500 partnerships when I was right out of college. And I hated doing the tax work. I was really kind of terrible at it. In fact, if I didn't quit the firm, I'd probably have been fired for sure. but I really just didn't like doing the tax work, but I love reading the partnership agreements. And I said, you know what? I want to be a deal maker like these guys. I quit the firm, met another guy. The two of us tied up a little apartment building and cold called a bunch of doctors. We probably broke every securities rule there was, but we called a bunch of guys and we got 22 guys to put in $7,500 a piece. And we did our first deal in the 80s.
Right out the gate, huh?
Yeah, right out of the gate. And then, I don't know, I've probably done 40 or so deals since then. So, they've gotten bigger and bigger. So I've done a lot of stuff.
Well, so when you say you were doing CPA stuff, working for a bigger firm and hated it, was it the people that you were doing the transactions for or reading their books that kind of motivate you to stop doing the W-2 job and jump into investing yourself?
Well, first of all, I was a terrible employee. I did not, probably a lot of people who were in real estate kind of understand this. I just wasn't a soldier. I just couldn't take orders and be told what to do and what time to do it and how many hours a day to work. And I just didn't like it. I was very rebellious. I pushed back all the time. But what made me not good at that job is what made me eventually successful in my career, my life. So I just knew it wasn't for me. I didn't like doing the tax work, but I just loved the idea of being a deal maker like the guys who were doing the deals. I wanted to be the client. I didn't want to be the tax doer. I just want to be on the other side. And so I was making, so little money at Price Waterhouse. I thought, I could sell shoes at Nordstrom and probably make as much money. So what difference did it make? If I would have quit later in my career, it might've been a different story. But as a youngster, unmarried, just kind of getting rolling in my life, it was a very easy transition for me to make. And I was able to, do some stuff. And right out of the gate, started just banging on the phone and telling guys that I knew a few things, which Maybe I did. Maybe I didn't at the time. I thought I did, but I probably knew less than I thought way back then. And, made a lot of new friends and connected with a lot of people. And, and there were some people that took me under their wing and helped me.
I think sometimes being just naive enough to take action is a good thing. That's kind of how I got started. I didn't know what I was doing, but I got going. I figured it out. Right?
In a certain way, it's not good to be too smart. If you're too smart, you just know too much about what can go wrong, and you focus on all these negatives. And I think you're 100% right in that. It's absolutely right.
So tell me about these 40, like you said, 40 or so deals. Did you have to raise capital for every deal? You still raising capital? Like how, and did the size of the deals get bigger and bigger as you went along?
Yeah. Sometimes it got bigger. Sometimes there's different kinds of deals that have different kinds of capital requirements. My biggest deal by far, after I'd been in real estate for some years, I got started in the mid 80s. By 1990, interest rates had started going back up, and the economy was going bad, and it just was kind of getting out of control. And I kind of knew that I wasn't going to be able to survive a downturn in real estate. I was just starting to make some good money, but hadn't made enough that I could carry a building, for 6 months if something went wrong. So I was approached by somebody who asked me a question. The guy said, help me learn how to do the stock market. Is there something that you could teach me about it? And I love the stock market. I was buying and selling, trading stocks every day. I was calling my broker all the time. And at that time, fax was a brand new technology. And so you might not even have been born at that time. I don't know, but this was 1990. And so I start telling this guy, hey, listen, here's what you do. Write down some stocks, keep track of them. And at the end of the week, we'll talk. Well, a couple of days later, the guy sends me a fax, and the fax had my name at the top, the stocks I picked down the side, and the prices of the stocks that I had picked. And I look at it 1 day, 2 days, the third day I call the guy up and I said, what is this thing? It's a very cool thing. And he goes, oh, just for fun, I put it in the computer. I mean, this was a brilliant computer guy. I said, you just for fun put in the computer. I said, this is amazing. I mean, every investor in America is going to want to have a report like this. So I started cold calling fax manufacturers. In fact, I went to one of their trade shows and I said, look at what we have. We have the equivalent of software for fax machines. And nobody was interested. So I get back home and I think, okay, I got to raise money because I need a lot of money and I knew how to raise money. I understood how it worked. And, that's the thing is once you learn how to raise money for one thing, you could raise money for anything. Once you can do real estate, you can raise money for a yacht or a bridge or whatever you want, venture capital, filmmaking, anything. Although real estate tends to be a little easier because it's more tangible.
Yeah.
So I get back home and I started calling newspapers, telling them about this new thing we had and the ability for us to deliver a personalized newspaper to every one of their customers. And, I got like no after no after no, one after the next. And finally, this one company says, oh my God, this is amazing. We got to hear about this. And they ended up giving me $10 million.
Whoa.
And so, now a lot of it was newspaper advertising credits, but plenty enough was cash that we could get what we needed done. So we got this great package, and I ended up getting 35 of the nation's giant newspapers to run our ads for us. And we ended up getting one of the giant Wall Street brokerage firms to be our customer. And I just was on the road selling, knocking on doors and telling people our story, which is what money raising is. I mean, that's what fundraising is, in a big way. So I succeeded with that and then ended up selling that company to a Fortune 500 in 1995.
That's awesome, man. So you basically what you're saying is you just learn how to raising capital is your way into deals, right? And the ability to do that. Let me tell you that, I'm a CPA by my training, but if somebody says, Joel, what are you? I tell them I'm a salesman. Because the skill that I'm the most proud of, the skill that will get me out of the hole if I'm ever in trouble, is being a salesman. And that is really the hallmark of what I believe in. That doesn't mean that salesmen stretch the truth. It doesn't mean that they tell lies. It doesn't mean that they make up bullshit and then do any of those things. It just means that they have the ability to tell the story in a concise and very powerful way
They really kind of hit the buttons of other people. You called it the tops of the waves or whatever you just said a few minutes ago. And I mean, that's what you do. You're able to kind of peel back the onion a little bit at a time and tell the story. And I was always good at that. And then I was able to get people to say yes. And that's it. I mean, and it's a really, it's a powerful skill. So if you can raise capital, if you have an understanding of how the deal works, not necessarily the real estate part of the deal, but the basket, the structure that the deal fits into, if you understand that, you're going to bring a lot of value to any deal that you come in touch with. In fact, I hate to say it, you'll probably bring more value as a money raiser than the other guys because you become a very desirable commodity everywhere you go.
Yeah, I think Steve Jobs, like one of his quotes resonates pretty well with me. And his quote was, if you can't explain it simply, you don't understand it well enough. And I think that's a very good thing to remember is whenever you're talking to somebody who's potential investor, there's left brains and right brains. Some people are going to be very, very caught up on the details, but most people just want to know like something that they can actually understand. And a lot of people who are very, very good real estate operators can't explain it like in a quick way. And the people that can are very, very good at it. But usually when they hear too much information or too many details, it's like, I don't need to know all that. You know what I mean?
Now that once you get a fund, I mean, my phone rings off the hook with people who want me to put money in their deal. So I get approached, not making a joke here, at least every single day. And it's kind of like I'm in the Shark Tank. I mean, it's having a fund is like being in the Shark Tank, whether it's real estate deals or note deals or venture deals or film deals or whatever they are. People will call and say, hey, will you do this? Put money in my deal. And I literally have learned to be able to tell in 10 seconds, if I want to hear more. Now, that doesn't mean I say yes in 10 seconds, but that means I'm interested in having an extended conversation. If somebody can't say something in 10 seconds that tells me something interesting, that hooks me into their life, their world, their whatever, then I'm not going to be interested. And in 10 seconds, like when I called the newspaper companies, I said something to them like, we have a technology that can deliver a personal newspaper to each and every one of your customers every day. Well, that was enough to get people to say, we need to hear more about this. Because at that time, the word technology was a buzzword. Personalized newspaper was important to them. Every day was important to them. So I kind of hit the bumps there for them, and they want to hear more. And everybody who does that needs to, learn how to do that, and I've taught a lot of guys how to do that. I mean, a lot of guys I've given in their pitch because, you have to, when you get on the phone, when you go to a cocktail party, when you're talking to somebody in person, if you can't say the right thing to somebody, like when they say, so Ramsey, what do you do? If you can't say it to them in a few seconds, and it's 10 seconds, because if they don't get what you're talking about in 10 seconds, they're going to shut you down. They're just going to emotionally just like close their eyes and go to sleep on you. I mean, that's just what happens. And if you tell them something that's interesting, all of a sudden, then they lean forward and they ask you a question. And when they ask you a question, like, tell me more about this. How does it work? How do you know? Whatever it is, then they're willingly giving you another 1 to 10 minutes of their time. I call the formula 10-1-10. You got 10 seconds to get 1 to 10 minutes of their time. And that's kind of how this all works. And the art form of raising capital it starts with having 10 seconds that are really compelling.
So when you say it's kind of like being the Shark Tank, which sounds like a good place to be, by the way, because people are bringing you deals, obviously, because you have the financial capabilities to help support them on those deals. How does that work? Like, how do they gain access to a fund manager? And then like, what are kind of the steps to reach out to them and then set up a call? Like, how does that kind of work?
Most venture capital and most fund type deals, are referral based. So they come through attorneys, they come to accountants, because I'm in the real estate world and people know who I am and people call me, and, we're not in a buying mode right now. Our particular fund is winding down for many reasons, but that's kind of what happens. I get a lot of inquiries on LinkedIn, just kind of out of the blue, most of which are not interesting to me. But, like today I was on the phone with a guy and he told me something that I thought was fascinating and that I really want to follow up on. I want to learn more about it. I want to kind of go deeper and understand what it is. He really made me curious. I mean, what he told me it just sounded true. It resonated as true for me. And that makes me want to learn more and kind of get into the weeds and start to really understand what he's working on. And my wheels were really spinning. And that's the deal. The Shark Tank, and the Shark Tank is a TV show, but that it really, for me, it's my life. I mean, like my life is looking at deals and being able to tell right away if I want to do it. It's not the Shark Tank because I'm going to choose somebody up and spin them out, or there's no competition. There's no other guys. It's not like that. It's like a panel, but that's just my life. I mean, and it's always kind of been my life. And it's funny for me to watch that show because that's kind of it's not perfectly accurate, but that's kind of how it is.
What's the biggest mistake people who are looking to pitch you guys can make whenever they're approaching you guys?
I'll tell you a number of things. One is they'll use language that's too dense. So they'll blur out a sentence that is just too long, complicated, and I can't follow what they're saying. Like if I can't understand what they're saying in 10 seconds, it isn't going to get any better in 20, 30, or 40 seconds.
Yeah.
If that first 10 seconds isn't clear to me, I've heard tens of thousands of pitches in my career. I've just heard it over and over. And if they don't say something that gets my attention, they're not going to be better at it in the future. I just know that doesn't mean they can't learn to be better at it, but it's not my job to teach them when they're coming to me asking for capital. So that's one thing is they just totally turn you off by saying something that just is too dense.
It's like fluffy, right? It's just fluffy.
It might be it might be fluffy, or it might be too detailed.
Yeah.
If it's too detailed, that's just as bad. Like fluffy is like we're gonna solve the world's problems. Okay, that's a little fluffy. Okay, but go too deep in the weeds. And that's not any better because I can't understand that either. I'm not a technical person. I don't know what you're talking about. I don't have deep background in a lot of complicated things. I mean, I can understand the problem. I can see your vision, and if you demonstrate some vision and you demonstrate, that you know what you're doing. And we're talking here about real estate. So let's talk about real estate. I mean, if you say to somebody that, we're going to repair the building, we're going to make it livable. Well, let's take a step back. Where does it all start? Everything starts with a problem.
Yeah.
That when you're raising capital, you have to say, if you watch a Shark Tank, they don't always do it this way, but I would counsel people to do it this way. First thing is, we have a problem. There is a problem in the world. Oh, really? What's the problem? Tell them what the problem is. And then, okay, what's your solution? Here's our solution to this problem. Wow, that sounds like a pretty good solution. How are you going to monetize that solution? And then you tell them how you're going to monetize that solution. And then you kind of give them examples about how you've done that in the past. I mean, that's kind of the rhythm, like in a 5 or 10 minute discussion. So you want to, come at somebody and say, look, there's this really big problem, and here's what we're going to do about it. And the person says, wow. Now, if the problem that you're describing resonates for them, like there's a housing shortage in our city, and we're going to do blah, blah, blah to solve this problem. If that makes sense to me, I think, you know what, you're right. We do have a housing problem. I keep reading about it in the paper or kind of keep hearing about it or whatever it is. And wow, well, what makes you the right person to solve that problem? What do you have? What do you have in your background that tells me that you could be successful solving this problem? Well, they kind of, then they can describe it. And if the thing kind of adds up and starts to make sense, then you have a discussion that can move forward. But you have to have the rhythm, and the rhythm is what problem do you solve, what's the problem, and then how are you going to solve it, and how are you going to monetize it, and what makes you the right person to solve the problem. And as you start kind of hitting those notes, what's going to happen is the person's going to start being engaged, and that's the art form of raising capital. Is you have to create materials. Like if you're going to produce fund documents. Attorneys can write documents, but attorneys don't write documents that people want to put money into.
No, I want to throw up when I read an attorney.
Well, but that's the job of the attorney. The job of the attorney is to get the investor to say no. That's it. You would think that, that the job is to get them to help you. It's not, because if the person says yes after they've read these terrible documents, and the documents basically say, every page says the same thing: don't do it, don't do it, don't do it. And then on the last page, it says, if you do this deal, you're a total idiot. That's
fine here.
That's what 100 pages of documents say. Now, you as the salesman, then at the end of the person looking at this says, well, you've seen what our attorney wrote. Do you want to do it? Well, you would think that after reading that not a person on the planet would ever do it. But the truth is, almost every building in America is owned this way, is owned through private placements that were done by guys like us. So clearly enough, people are doing these deals. In fact, you won't believe this, but the private securities market, and there's the public market, which is like AT&T, and these giant companies are on the stock market. Guys like us deal in the private securities market, where you have to be accredited or you have to kind of know somebody to get into these deals, right? Did you know that the private securities market is actually bigger than the entire United States stock market? So this private placement business, the fund business, the syndication business, all the stuff that we do is bigger. Why? Because almost all the real estate, almost all the investment real estate in the country, from the biggest buildings to the industrial ones and the shopping centers in your neighborhood, are almost always owned by this. A bunch of doctors, attorneys, business people. They put their money together, industrial places, they put their funds together, and they go and they buy real estate. That's how all these deals are owned. So office buildings, shopping centers, they're owned by groups of people in private placements. And so, that's just the deal. Somebody had to sell these deals to some group of people. Yeah. Somebody had to get good at these skills. Somebody had to take what the attorney wrote down and turn it into art. And if you leave an attorney to go by himself, they probably won't do that. But it's a business person, a guy like me, that turns that material into art that a salesperson can go out and discuss.
So I want to talk about now, Joel, is lately, and as you know, the market has shifted quite a bit post-COVID. We are seeing a lot of the more serious hedge funds, like what we call institutional money, where they typically 200 doors or more was what kind of like piqued their interest. That number has been going down to where now a lot of the institutional money is reaching in the 100 plus, even sub 100 apartment size complexes. And it really is making the market so extremely competitive. It seems overpriced. We're looking at properties selling at 3 and 4 caps in areas that used to sell at 6 and 8 caps. Can you give us some insight as to why that is? Like, what's the mindset from an institutional money perspective on why these assets are now more appealing to purchase than they were, 3-4 years ago?
Well, it might not be that the assets are more appealing. It might be that they are not successful getting larger assets because the competition is so great. A lot of institutional money has moved into real estate. 10 or 20 years ago, it wasn't quite as fashionable to be in real estate. The real estate markets were really poor. They were buying paper, but now they really want to own the real estate itself because the real estate itself produces property management fees. There's lots of annuities that come out of real estate, and real estate itself is like a bond. It's every month, it just cash flows. It just money pops out. You pay the tenants pay the money. So a lot of money is chasing these deals. And because there's a lot of money that's being held by these funds, which in our business is called dry powder, there's just a lot of powder, and they got to put it to work, because if they're not putting the money to work, they're losing money on it. And if they got to pay extra, then what they tell their investors is that we're just going to hold it for longer. So ultimately, they end up making money by holding it longer, and that's kind of the game.
So, but what has happened to where? Because I kind of, at least in my head, I understand, like, people are collecting money into these funds. These funds have maybe a pref or whatever it is that the investors are getting a return. And now you're like, oh, I got to spend this money and get at least that return or better. What went away that made real estate so attractive? The stock market stopped pushing.
First, understand, professional syndicators use the pref model and a split, and a split. Yeah. So pref and a split. That's not what the Wall Street guys do. The Wall Street guys run it like they're on a stock fund. They'll do what's called a 110 or a 220. And 110 means that you get a 1% asset management fee plus 10% of the profits. So there's no pref. So what 110 means is if a company has $1 billion under management, On January 1st, they get $10 million, which is their 1%. And at the end of the year, if there's any profits, they get 10% of those profits. But most of these firms are really in the business for their 1% or their 2%, depending on what kind of asset they're managing. And so if you're doing a 1% or a 2%, it doesn't matter that much, because it's not like there's an 8% preferred that you have to get. It's not a hurdle and a waterfall like what we're used to. They kind of have a different model. Those institutional investors are trained for something different than what we do. And that makes it easier for them to sell into real estate. So as stocks and bonds, did very well, which they have over the last 10 or 12 years. And real estate has done very well over the last 10 or 12 years. It's been very easy for these funds to pull dollars into the real property markets, because number one, you have hedge against inflation, and that's going to get even more dramatic now because inflation is guaranteed. It's happening in a big way, and it's going to continue. Unlike what the White House says, the White House says, well, just wait for the ripple of the supply chain to stop, and then it's going to go back to normal. It is not going back to normal, because there are some things that when they go up, they do not come back down, like labor. Labor prices have skyrocketed.
Yeah.
And so labor, you can't, just because you pay a guy $20 to make a hamburger now, you can't call him later and say, oh, the price now back is down, so we're going to move you to 15 or 10. Yeah. It doesn't work like that. Not only that, but the guy that now is making 20, it's not exactly enough for the guy to go get a better apartment, because it's still not a lot of money. But that person is buying groceries that cost 10 or 20% more than they cost before. They're buying a car that costs 10 or 20 or 30 or 50% more than it cost before. Their rent is costing more than before. So once the spiral starts going up, it doesn't come back down. So money, there's a lot of factors that have moved into all of this stuff. And that's, I don't know if that explains it, but there's the business model that the hedge funds like. There's the competition that the hedge funds are dealing with. They got to put the money to work. They like the business model of real estate. There's just all these factors that combine. And the bottom line is that they're moving into your space.
Would you agree with the statement that real estate's not worth more, the dollar's just worth less?
That's kind of philosophical. And I guess we could have a philosophical discussion about it. I mean, what difference does it make if it's the real estate or the dollar? The bottom line is it's buying power. So, yeah. If the real estate causes you to have more buying power because it gives you more dollars, then it's a win-win. So I would kind of defer on that one, because they kind of seem like they're both the same.
Well, I say it a lot, and I was looking for someone like you to back me up on it. But maybe, because the reason I say that, I tell that to investors, I'm like, look, your money, the price of gas is going up, the price of labor is going up, the price of everything is going up except for the value of the money in your bank account right now. So it's not like the house that you currently live in that's worth $100,000 more than it was 2 years ago. The house hasn't changed. You've not made it better. It's just a regular house. So the value of your house hasn't gone up. It just takes more dollars to purchase it, which means the value of the dollar is going down. That's kind of how I explain it.
Okay, that's true. I didn't hear that when I heard your statement.
Okay.
And so I maybe have to hear the statement again. But the truth is that in an inflationary environment like we're in right now, and we're moving into even worse, cash is not a good thing. So money is going to be moving out of cash. Now, what typically happens in this situation is that as interest rates go higher, because not only do we have the supply chain causing inflation, but we have now interest rates are going higher, which is how the Fed's going to try and control some of this. Normally, when interest rates go higher, people move money out of the stock market, which has some risk, and into bonds, because bonds have less risk. And as interest rates go higher, then you're going to get a better yield for less risk. That's why that happens. And then people also move cash out of the bank, and they move it into things like gold or into real estate or into things that are a hedge. In fact, more recently, they're moving into cryptocurrency because it's a good hedge. So long and short is that cash is not a good thing in times of inflation. So if that's kind of what your sentence was meaning, then you're right. I just didn't hear it maybe the way you said it, but yeah, for sure, the real estate is a good hedge because it goes up, whereas cash actually gets worse.
I was practicing my 10-second pitch. It sounds like I need to polish it off a little bit for you.
Yeah, we'll work on that. Another time.
Yeah. So when it comes to capital raising, like myself, I'm in capital raising now. I've been doing it for, let's say, a year, and we've done 2 syndications, and our access into the deals that we've done has been our ability to raise capital. And I'm not talking about millions of dollars. Like last year, we started capital raising. We raised over $1 million our first year. I thought that was great, but we're doing it 506B, which is friends and family. It seems to me like, because whenever people say, hey, we have this deal coming up, it's 506C. I don't know if it's a limiting belief of ours, or maybe it's I just don't have confidence in our network, but it seems like you're jumping to another level to where you can now advertise to accredited investors. What advice would you have for someone like me who needs to get out of the family and friends network and jump into accredited investors and gain access to those people who I don't have a relationship with? How do I start building that relationship so that they trust that we know what we're doing? What advice would you give?
Let's talk about it. Let's break that. That's a giant question. So let's break it into some pieces.
Okay.
First, 506B is not friends and family. 506B is accredited and non-accredited. So there's no advertising. So I don't want to dispute that part with you, but the most giant deals you could think of are 506B deals. I mean, that's hedge funds are 506B deals. I mean, there's no advertising. They're kind of inside guys that just know what's going on. And so it's not limited to just friends and family. I mean, it's like anybody. So the question about how do you expand your network, that's a great question. And we'll talk about that here momentarily. But the second part of this is, how do you get guys to come into your deal? If it's your inside guys, there's one thing. If you're dealing with 506C, which is the crowdfunding rules and the advertising rules, that's something else. When I hear people say they're going to do 506C, I'd say 99 out of 100 of them fail. And the reason, it's not the rules. The rules are great rules. I mean, they're fantastic. It's awesome to be able to advertise. But the truth is, very, very few people know how to advertise. Very, very few people understand how to get Facebook to squeeze leads. Very few people know how to follow up on leads. Very few people know how to drip on leads. Very few people know how to kind of work in that whole marketing system. If you're really good at real estate, you're probably not really great at social media marketing. And so you probably have to hire somebody that's really good at it. So in addition to the attorney, in addition to all the other expenses that you're going to have, you got to put money aside for that, which is not a bad idea. But almost nobody does that. They try to do it themselves and they fail. And especially that's so because you have to advance the money before the investors come in, and then you may get reimbursed after the investors have come in. But that's the problem with 506C deals. I like the 506B deals better. That's me. I personally prefer the B deals. So how do you expand your network? Well, the first thing is you have to talk to everybody. I mean, everybody that you talk to, you have to kind of be looking for, who it is. And it sort of happens almost in a geometric way where it starts slow and then it accelerates over time. So right now you've got $1 million. You need to go back to those people and say, how are we doing? You know what? You're doing pretty good. I'm getting a check every month or every quarter. You're doing what you promised. It's working. Fantastic. Is there anybody you could introduce us to? You have to be aggressive asking for referrals and introductions. The next thing you might want to do is you need to go places where bigger guys start hanging out. And let me just give you a tip that everybody wants these whales. Whales are not really the answer, because somebody that, understand, Ramsey, a guy like you, similar to me, we tend to work with people whose net worth is probably under $20 million. They're not really wealthy. I mean, they've got some good money, but they're not really wealthy, because by the time a guy gets 20, 50, $100 million, they don't need people like us.
Yeah.
They've got an entourage around them that have kind of built a little fence. So you have to be very clear about who you're going to go after as targets. And you really do want to focus on these people that have a good net worth, but they're not so constrained by the entourage of people, the brokers and all the network of people that keep their arms around them, the attorneys, the accountants. Because the truth is, they don't want guys like us to approach those investors. They want to keep those people in themselves so they can make some money on whatever it is that they do. And we are really kind of more of a problem to them. So you got to get a really good picture, an avatar of who your customer is, what they look like, how much money they make, where they hang out, where they are. These are not necessarily the wealthiest people. When people tell me they're dealing with the wealthiest people, I immediately think that they're probably in for some trouble, because those extremely wealthy people are hard to get a hold of. They really don't need us. They've got all sorts of other alternatives. Most of them are not hungry for large rates of return, which is what a lot of smaller guys are pitching as higher risk, higher return deals. By the time a guy's got 100 million, turning it into 200 is not really the highest priority in the world for that person. That person's priority might be to preserve the capital, live on the interest that comes off the capital, and then give the money to his kids. That might be the formula that guy's got in place. And when I say guy, I don't mean male or female. It's just
the person,
just the way that I speak. But and that's kind of what it is. So you have to be very thoughtful about who your prospects are and how you're going to get to them. So if your goal is to get to people that have a net worth of 5 to 20 million, let's say, where do those people hang out? Who are some of their friends? Because let me tell you something, a guy who's got 5, guess what his friends have? His friends also have 5 or maybe more, because people with 5 don't hang out with people that have nothing. They just don't. They kind of hang out with their own kind of people. And so you have to break into those circles and you have to earn your way in. And if you keep banging on the door, I guarantee you're going to earn your way in. You're going to get one of those guys to give you a chance one time. And if you do good, that guy will introduce you to all the friends. And next thing you know, you'll have 20 guys that'll, because just like you're having a hard time finding them, they're having a hard time finding people they trust. Because don't forget that they may already have somebody that they're with, but they've been with them for 20 years. And maybe the guy's not doing that great anymore. Maybe the guy's ready to retire. Maybe that guy made a lot of dough and is ready to go out of the business. Who knows what it is? Maybe the guy's ready to turn the business over to his kid, and you hit it off better with the kid. But if you're not in the game, you're never going to be invited to the dance. So you got to be at the door banging, banging, banging all the time. And then one of these times, somebody's going to ask you to dance.
That's what Denzel Washington said. You hang around the barbershop long enough, eventually get a haircut.
You know what? Well, in our business, a haircut's not a good thing.
Yeah. Well, that's being in the military, haircut's mandatory, man. And I tell you, it's another thing about being in the military. And this was a kind of the guys I partner with, one of them's in the military, a couple of them aren't. And so I was like, look, man, most of the people that I work with, we're all just a bunch of broke government employees, man. So like, how are we going to raise capital? And it turned out that a lot of these dudes, they have W-2 jobs, they get bonuses, they have equity, they have to live in, like, if you're in the Navy, you usually live in the nice city, like San Diego. They were able to buy a home with zero down with the VA, and their equity has gone up. I get a lot of military investors, $50,000, $100,000 dudes who are interested in investing. They just don't have the time to get into it, that have helped us raise capital. And when I say, and this is kind of the point, like 506B, 506C, regardless of advertising, not advertising, our network is people that we know right now. And I'm not trying to go away from the people that I know, but I need to expand it into people that I currently don't know, because it's not that I'm tapped out on the people that I know. It's that the people that I know who are going to invest in us, if they've already invested, they can only do that once, right? They can't do $100,000 investment every year. They got to wait until we sell out the asset, they get their money back, and they may put some back in, but that's 4 or 5 years down the road.
But you've got an avatar. You've got a picture of a person that you could replicate in other cities, in other places, on other bases, wherever these people are hanging out. And maybe what you need to do is launch an educational campaign, not a sales campaign that requires a 506C, but an educational campaign to teach these people about some of the different techniques maybe that they can use to invest in different types of deals. And so when you're providing this investment advice to these people, not investment what to buy, but how to maybe increase your wealth, or how to be involved in real estate, and give them some options. When they get ready to do it, who do you think they're going to call? Are they going to go to the Yellow Pages? you know,
and Cardone.
So,
no, I'm just kidding.
well, hopefully not. I mean, so, that's kind of maybe what you got to do. Maybe you have to start planting some seeds in some other places and start developing some routines with some other people that you're not developing those with anymore right at this time. And again, you don't want to go there and sell. You don't want to go there and pitch. You want to go there and provide value. And you want to, it's kind of a long-term play. But, some networking is maybe a little bit of a shorter term play. But if this is an avatar that you like because they trust you, because you're one of them, then, I guarantee you can make a lot of dough from that, from that vertical. I mean, it's a great vertical and it would be a natural place for you. There are some other verticals you could do too. And by the way, they're not mutually exclusive. Just because you do one doesn't mean you can't do the other. But I would tell you that if these military guys are working for you, that I would provide them education, help them understand the asset class that you're working in, and help them to figure out, who to work with and who not to work with, and how to make an examination of assets or whatever, you want to teach them to do. And then when they're ready, they're your guys. But don't sell them anything right now. Just provide them with some background.
Yeah, I can't stand being sold to. The moment I feel like I'm being sold on something, I get kind of grossed out by it.
Yeah, well, nobody likes it, but everybody wants to learn.
Yeah.
And so if you can genuinely be somebody that helps them to learn, and you've got a lot to share, listen, you got the podcast, you got all these other different assets that can help people to get better at some aspect of their life, then if you do that, they will become very loyal to you in the long run. Now, that may not be fast enough for you. So you may need to work another vertical at the same time, but that sounds like a really, really good vertical. Imagine if you had a steady flow of people that put up 50 or 100 grand, when you needed it. So every, couple times a year, 3-4 times a year, you go out and you do a pretty good size raise. If you did $2.5 million a quarter, $10 million a year, it wouldn't be very long from now before you'd have hundreds of millions of dollars.
I agree. So when it comes to capital raising, one of the things that I've talked about with our team is because we have our team, which is the Real Focus Group. That's like our syndication company. But we've talked about, which brand do we put more time into? Our business's brand or our personal brand? Can you kind of talk about the importance of a personal brand versus like a logo, or like which one do you put more time into?
Well, me and my brand is the same. If you have partners, unfortunately, there's always the chance that something isn't going to work out, and you put all this energy into the brand, and then somebody else ends up with the brand, and you end up with just nothing. And so it's a very complicated thing. So I would probably, if you're in a partnership arrangement, I would probably encourage you to put the brand into yourself, that you're the brand. So use your personal name. And then, of course, it's attached to a company, but you might move at some point in the future, and you want to be able to take all the value, all the databases, all the stuff that you have that's part of your personal brand, that's part of your personal, universe. You want to be able to take it with you. I mean, that's just the reality of relationships. They don't always, survive.
And that's kind of, I think that was kind of the conclusion of the discussion we had, that most of our investors that we have right now, they're investing in me as an individual, or my partner. His investors are investing in him. They understand that they're investing in the group, the team, the vision all together, but a lot of them wouldn't invest if one of us wasn't on the team, right? That's
the reality of capital raising for all of time and all into the future, is that ultimately they're betting on you. And they want to know that you have influence and control over the deal, that, you're part of the deal, and that you're going to look out for them. And that's a big part of what happens.
Okay. Well, so earlier you had made the comment that your hedge fund is kind of drawing down from spending right now. What's the reason for that? What do you see in the market that's causing that?
Well, no, it's not because of that reason. It's funds have a useful life. So you set up a life for the fund. It could be 5 or 7 years, and ours is at the end of that life. And we promised the investors that we would be done. So we're winding everything down. The investors get all their money back, and we finish up our business, and we just close it down. That was the deal that we made with the investors at the beginning of the fund. I also think that things are starting to slow down now. I don't think that real estate is going to collapse, but I think that the I just think that the escalation is going to slow down. Yeah. And we're going to flatten out a little bit. That doesn't mean forever. It doesn't mean it's a bad time to do anything. It might be a good time it's a really good time to buy some stuff that's in distress. And there's a lot of different kinds of distress that are coming up, especially in the commercial markets. A lot of larger companies are having a hard time because of the pandemic. The supply chain issues have caused a lot of problems for companies, and they're having to give up certain office space that they've had. So there are lots of problems in the commercial and industrial space, retail space. As far as retail, as far as residential, we have a shortage in the country. And so those prices are going to continue to potentially go high, even if interest rates go up a little bit. I don't see home prices really dropping that much because the supply is limited.
And how is that that there's a shortage in supply? Because all the people that were living before COVID are still living somewhere. Like, what is it that whenever I did my market research, I realized that builders kind of stopped building after the crash. They were doing more fix and flips. They started picking up on new builds a lot more about 2016 when the market kind of stabilized the inventory. They realized that the inventory was low and there's a need for more housing. But what was it about like COVID that really made the market shoot up? Was it just the dump of institutional money that skyrocketed prices coupled with the housing shortage? Like, what do you think caused this?
Well, you got to remember that, everybody's familiar with the stimulus that the government put in. All the people got people got enormous amounts of money. They got unemployment money, they got stimulus checks, they got PPP loans, they got SBA loans. I mean, hundreds and hundreds of thousands of dollars came in for in some cases each person. I mean, massive amounts of money. And most of it for free, some of it very low cost. But in addition to the $6 trillion that the government gave to people, the Fed put in another many trillions of dollars, something like four. We don't totally know all the numbers, but something like $4 more trillion went into the economy from the Fed. So businesses got enormous amounts of stimulus. And just all this money poured in and it had to go somewhere. That's part of why the hedge funds have so much capital, is it just all this money poured in and it had to go somewhere. That's why the stock market is high, is because that money had to go somewhere. And it's really gone to prop up investments because there's a lot of money that's chasing not very many deals. There's a couple things about it I don't understand. I don't understand how the average savings rate in the United States can be what the media says is like $400, but yet people don't want to work. Those numbers don't reconcile to me. It's like if you have $400, it seems like you kind of have to work. So somebody's got some money that makes it possible for them to want to change jobs and not want to work. Or I think maybe more likely is that people are moving into the gig business and the entrepreneur business, the self-employed business. Or they're making money doing crypto, or they're making money doing real estate, or they're making money away from corporate America. And that's kind of what I think is happening. But people are making money. People are making money doing crypto deals. People are making money doing stock deals. People are making money doing real estate deals. And I think that the technology boom over the last many years has enabled a lot of people to make a living in a different way. And that different way is enabling them to buy real estate in a different way. And that's creating more demand, and there's just not enough supply. So I think that there are a lot of factors. There's never a single factor. And I think that several of these things are factors that are playing into this.
How do hedge funds or fund managers, I'm guessing whenever you set up your fund, you guys have kind of a swim lane which you operate in. You talked about distress assets. If something creative comes up, like you're talking to a guy who really spiked your interest on something, but it's a creative thing that's kind of outside what the fund was meant to do, what's your latitude to be able to shift gears on the fund and say, well, we like this asset class? Are you able to do that? Or are you legally bound to not be able to invest in certain asset classes because of your fund's limitations?
We write the operating agreement in a way that gives us a lot of latitude. And again, this is why it matters who your investors are. If you're dealing with a $50 or $100 million investor or a professional investor, like a big fund, a Wall Street fund, they're not going to give you any latitude. They're going to clip your wings really, really tight. But if you're dealing with for example, the people you're dealing with, they're going to give you a lot of latitude. So you'll probably say something like, we're going to buy distressed assets in the southwestern part of the United States. That's kind of your marching orders. I call that's a theme, or that's kind of a charter for your fund. Well, if something different comes along, if you have wide-ranging powers where you say, this is our theme, but we can do anything that's legal, and that's, what our documents say, you can do anything that's legal. That doesn't mean you can just go off and do anything legal. I mean, that doesn't mean that you buy a drive-in movie theater, or buy other, like a bowling alley. You don't do things that would be politically problematic with your group. But what you could do, I mean, you have the right to do it without taking a vote. But I'd go back to your top 4, 5, 6, 10 investors and say, look, this really cool opportunity came along. Would you like to, do you think we should, do this, even though it's kind of different than what we had thought? If people generally agree, you're larger investors, if they're kind of behind you, then I would move forward. The other way to do it is just by, your fund is kind of your ongoing thing, but you might have 4 or 5 investors just say, hey, really like this deal. The fund's not going to do it. Why don't we syndicate this deal and just do this as a separate project, just a few of us? And that's an okay thing to do. If it's outside the charter of the fund, then, and your fund's not going to do it, then just go ahead and do it yourself. So there's a lot of ways to make that happen. It's possible to do it inside your fund. I mean, that's one of your options. It's possible to just do it outside your fund and not cross that line. I love the concept of a swim lane, by the way. It makes a lot of sense to me. It's a really smart way of framing it. But there's also ways to either work it in or work it out, depending on what you think the right thing is. Like the thing I saw today is so far away from distressed real estate assets that I wouldn't even contemplate putting it in the same bucket. It's so far away.
So what's the benefits of, because we've only done syndications where it's kind of like pack your parachute mid-flight. It's like we have a deal, we have it in our contract. Now we got to go raise money for it because you don't have the fund ready to go. We need to go raise capital for this one asset, close it, asset management for 5 years and get out of it. But that syndication's for that one granular property. And what's the benefit to doing that versus having an ongoing fund? And what's the disadvantages of having an ongoing fund versus a syndication?
Good, very good. First of all, the difference between a syndication and a fund is an ongoing pool of money that buys and sells things, as opposed to a syndication, which is a project. So a syndication, for example, you might buy an apartment building, rehab it, sell it. Then you give all the investors back their money and their profit, their capital and their profit. You take your cut, you clap your hands, and off you go, and you're done. And then you go find another deal, and you start to cycle over, and you call up people. Hey, by the way, now we got another new deal. Do you want to come back on that? Hopefully they do, and maybe they don't. You don't know, and you're always in money raising mode, always. A fund, on the other hand, is you go find an apartment building, you buy it, you rehab it. Let's say you sell it. You give the investors back their profit, their share of the profit. You get a cut of the profit too. And then you keep the capital, and then you keep the capital moving into the next deal. So if you have a fund, you have to be really good at finding deal flow because you've got capital that you got to find deal flow for. If you are a syndicator and you've got deal flow, you got to be really good at raising capital because you don't have a lot of time to do that. So it sort of depends on, what you're good at. If you're good at raising capital, you're good at finding deals. If you're good at finding deals, then having a fund is a really powerful tool for you. But there's sort of something bigger than that. And that is that syndications, funds, these are financial tools. They're sort of like golf clubs. Yeah. Sometimes it's the right tool to use as your driver. Sometimes it's the putter. And you have to pull the right tool out of your bag at the right time. So, for example, you might have a fund, then all of a sudden a bowling alley comes up, and that might be a syndication project that you just do on a one-off basis. It's possible that a different asset class pops up because there's something about the media that's telling you that you need to move into a different direction, and you might start another fund. So it really depends on a lot of these things. Now, pros and cons. I will tell you that it's easier to raise money for a syndication than a fund. Because in a fund, you have more discretion and the investors have to trust you more. Okay. So a syndication, hey, we're buying this particular apartment building. come on over, get in my car. We'll drive over, look at it. They look at it. I don't know why they need to look at it because they don't understand what they're looking at anyway, but they look at it and they say, yeah, I like this. It's a pretty good building. Fine. I want to be in this deal. Whereas a fund, they're giving you discretion to buy buildings that meet a certain kind of criteria based on your theme. So they have to trust you more. And that's, but interestingly enough, what you find out is that earlier stage investors have a hard time trusting and they like syndications better. Wealthier people like funds better because they really don't want you calling them every 2 weeks saying, hey, we got another deal. Do you want to put your money in? This money's expiring. This money's coming back. They just want to set it and forget it. And they just want to get their money every quarter or every month and just keep paying them the money. And that's really what they want. They don't want to be bothered as much. So it's not like one's better than the other. They're financial tools, and you just got to use the right tool for the right job.
I'm going to open up my my bag of worms real quick because I've been looking at a fund because we've only done syndications, and the large multifamily assets from what I'm seeing, 4 and 5 caps and markets that don't necessarily make sense for that. And then the returns, if there is any prep for the split, it's getting so competitive that the only people making any money are the investors and the operators. Like you're getting squeezed so thin. And I've always kind of had the thought process, if there's books and educational courses all over the market about a certain way to do things, then the money's probably already been made and people shift to educate people. Right. And there's one asset class that fell in my lap, and it was a boutique hotel. It was like a small hotel down Southwest Louisiana. Bought it from a friend. And people, my listeners are probably getting tired of me talking about it because it somehow it comes up every episode. But it's like the most unique little thing that I've ever bought, and it cash flows really well. But a lot of these boutique hotels don't make sense for syndications because the PPM, the price to get the PPM thrown up is like 15, 20 grand per deal. And a lot of these smaller boutique hotels are in the $1 million or less, maybe $2 million or less range. So I thought I'd like to start a fund that kind of backs me to where I can go out and buy boutique hotels because I've got a method of making them more efficient, operating better. I just need like having to pitch that to everybody on every individual hotel. Not that I'm not willing to do the work. It just sounds exhausting for the size of the asset. But I know that I could go out and purchase these things and find operators to manage them, really using the short-term rental platforms and Superhost and stuff like that. And the deals are out there. Even if you look on LoopNet, the numbers make sense on a lot of them. And there's still a lot of ma and pa operators that own small boutique hotels. And I've got a formula to make them work. Would you recommend setting up a fund that kind of gives me the latitude to buy this asset class? I've even got a couple of the markets picked out that I want to do it.
That's a perfect fund. That's a perfect fund. Let me first tell you though, if you can get your syndication paperwork done for 15 or 20 grand a piece, and you got to raise $2 million. I mean, that's 1%. That's really not a lot. I mean, so, kind of keep some perspective about that. Number one, a fund though, you only have to build one set of documents. They're a little more complicated set of documents, but you once, and then you just use them for a long, long time, and you keep cycling them over. You don't have to keep doing a new private placement every single time. But the idea of a fund with the theme of what you just described, these boutique hotels, I love that because number one, what's the problem? There's obviously some problem that these families are having, whatever the problem is. The hotels are getting older. They don't have the cash to rehabilitate them. They need some cash. What's your solution? You can have a solution. I mean, it makes a lot of sense to me. And if there's for example, a lot of guys do mobile home parks. And let me tell you another thing that you may not be thinking about. If you do a roll up, if you gather up all of these little hotels, let's say you have 5 or 10 or 20 or 50 of them, some hotel company, some private equity outfit will come along and say, we want all of them. We'll buy the whole portfolio. And instead of giving you a 6 cap or whatever it is, they'll give you twice the value because you've done the work of the roll up, because you've created what's called accretive value, more value than the thing is worth by itself. You just have added value to the portfolio by the fact that you've done the turnaround for them. And that could be a home run for you.
So a fund, to get started on a fund, do I just go to a certain lawyer and say, this is what I want to do and put up the money to get the fund started? Or do I start to kind of raise, because I do have friends who started a fund. And one of the things that he said he had to do is he had to take his existing portfolio and purchase it at a discount to what his equity was, buy the first little bit of money raised in the fund so that it could feed the investors, what their returns they were saying, but that gave him the ability to continue raising money to purchase more assets. Is that something?
That's one way to do it. I'll tell you what, we probably build more syndications and funds than almost anybody in the country. I mean, so this is a big thing that we help a lot of guys with. Our symposium, we've been doing this, syndication hedge fund symposium for a lot of years now. A lot of guys have come through it, and we probably have spawned 100 funds and maybe close to 200 syndications. And all told, all the guys that have come through, they've probably raised something close to $1 billion in equity dollars. I mean, that's a lot of money considering that these are not institutional players. I mean, they're getting money from high net worth people, just regular guys like what you're talking about. So it's a lot. There's a couple different ways to get started. One way is if you have assets that are all kind of, like splintered, like just different places, you can roll them into your fund. So your fund starts with some assets. That's one possibility. The second thing is if you start with a new thesis or a new charter, you just start it from scratch. And we could talk at maybe a different time about what start from scratch means, because that's kind of a little bit of a longer discussion. But there's a lot of different ways to get started. And but I think the most important thing is you got to come up with a concept. Here's the second most important thing is, and this is kind of where a lot of attorneys kind of miss the mark. And I love attorneys. You need attorneys. You can't do this without attorneys. So it's not about that I don't like attorneys, but attorneys are good at certain things. They're not good at certain things. And you have to sort of be like a casting director and have people do what they're good at, not ask them to do what they're not good at. And so attorneys are advocates for you. Their job is to advocate for you. That is what they do. And when they write their documents, they're going to advocate for you to have the best deal you can have. Well, sometimes you getting the best deal in the world means that the person on the other side of the table, the investor, is getting an inferior deal that they don't like. So you have to be very sensitive to make your deal investor friendly and make it something that people want. And the terms have to be reasonable. Now, at the same time, you have to get paid properly for your time. And you may or may not even know what get paid properly means. I mean, you may be leaving a lot of money on the table, and I guarantee that you are. I mean, we're practitioners. We're in the field. That's what we help guys do, is to figure out how they're going to get paid. And I promise you that the amount you're going to end up getting paid is going to be enormously more than whatever we charge you, because it's just, we're going to show you kind of the way that the world works and how it works. And it's got to be done in kind of an industry standard kind of way. Yeah. So that people don't get surprised by it. So when their attorneys or their accountants look at it, they don't see something that's ridiculous. They got to see something that they recognize. And having, remember I told you that I did all those tax returns at Pricewaterhouse. I learned this business from some of the best guys. I mean, I didn't make a lot of this stuff up. We've refined a lot of it and made it better. But I mean, my foundation came from, what I learned as a youngster, kind of being in the institutional business.
So this is what you do. If people want to set up a fund, they reach out to you, and you have the ability to get them to set it up.
We build a lot of them. I mean, we got a lot of them going right now. And this is a very, very busy time because there's a lot of money on the sideline. Interest rates are changing. Inflation is changing. People are getting ready to move money out of bank accounts and into real estate. And there's a lot of opportunity. And there are guys going broke at the same time. Landlords are going broke. This eviction moratorium did a lot of damage in a lot of cities from the pandemic, especially in California. I'm sure your city, like my city, dealt with all sorts of problems. So real estate markets are ripe for people that have cash. And so a lot of people are organizing themselves to make sure that they have cash so that they can do deals.
Okay. I'm like you, May 1st in Vegas. What's the name of your symposium?
Oh, well, the name of the program is the Syndication Hedge Fund Symposium. So people that are buying real estate, they're doing real estate deals, even if they've syndicated, a handful of deals already, I guarantee that even if you've syndicated stuff before, we will show you how to do it better. And we help people to, understand how syndications and funds work. It's a potent audience of people. Everybody who's there has to qualify in. You either have to be a real estate professional licensed in some state, or a financial or intermediary type person, or an asset class specialist, which means that you've done a bunch of deals. I mean, you've either rehabbed a bunch of houses, or you've built ground up, or you've done whatever you've done. So nobody in the room is going to raise their hand and say, "Why do you need to use an escrow?" I mean, everybody's been around the block, and my job is to teach them how the money works, because real estate the money's not made in the real estate. The money's made in the money. The guys that make the big money in real estate are the guys that control the money. So, you're starting to get a taste of this as a syndicator. The more money you control, the more real estate you can buy and the more money you can make. But you got to do it right. There's a formula for how you do it. And we share the way that works.
What's the biggest? So for people who are out there actively syndicating right now, you said that, yeah, you're syndicating. We can show you how to do it better. What is like the biggest two things that you see that they're doing that they could optimize or make better?
Yeah. Most of it has to do with their profit sharing splits and the way that they take their fees. Those two things. Most people, are woefully short on the fees that they take. They don't get paid for all the things that they do. That's not to be abusive, because you have to disclose everything that you do. But, you have the right to be the vendor to your own deal if you're properly licensed to be that vendor, if you're qualified to be that vendor. And you should get paid an arm's length fee for the things that you do. In the syndication and the hedge fund business, you're paid for two things. One, you're paid for your time. The second thing is you're paid for being smart. Most of the people who are doing it now are only being paid for being smart. That means they found a really good deal and they make some money on it in the future because the price went up. That's being smart. That's great. But by the time you get your payout, a lot of guys, especially if they're like fix and flippers or whatever they're doing, they're broke before they get their payout because so much time has gone by before they got their money. What needs to happen in a syndication or a fund environment is for the deal to pay you for all the different things that you're doing along the way so that you keep your lights on. And the investors want you to keep the lights on. The investors, in a fix and flip deal, the investor has an incentive for you to fail. In a syndication where you're in charge and the investors are passive, they don't have the same incentive for you to fail. They want you to succeed. They know you need to keep your lights on. And so, most of these people are substantial people that are okay with that. And if they're not okay with it, they're not good investors for you. So one thing is the formula for how they take their fees. The second is the formula for how they split their money. And, we have a couple different formulas that are a little different, but I promise you that when guys hear them, they're like, wow, I wish I would have thought about that. That would have made such a big difference for me. And that's those two big things. We spend a couple hours working on these formulas in the program.
So I've been on a couple of the underwriting calls where we're actually underwriting like off-market deals or deals that would pencil out. And we look at kind of the process that we go through is we'll start it out and say, all right, is this good as a 50-50 split? And chances are with the prices that they're on the market for right now, chances are no, that the investors won't make any money. Okay, do we do 70-30 split? Still won't work. 80-20 split. We're not going above 80-20. Is there a pref that we can take away? And it takes out the way that we look at it, say, all right, how can the operation team make the most money while still providing investors a good enough return to make them want to invest? And then really what starts to happen is you see all of your operational fees started getting reduced down until you say, okay, how can we give them a good return on investment and still get paid? And if we can't get paid at all or whatever it may be, we have our criteria, then we won't do the deal at all. But really, that's kind of what it's come down to, at least with the deals we're looking at. And we're operating mostly in Texas, which Texas has been a hot market and the prices are really high. A lot of the deals aren't penciling out at even 80-20 splits with no prep, or with prep, whatever it may be. It's.
Let me comment on that.
Please do.
If I can. And I'm going to give you some advice here. It sounds to me like you're jumping around. You're looking at this kind of real estate and this kind of real estate like this. You need to have a pretty clear picture of what you're looking for. And here's what I mean by that. If the hedge funds and other guys are coming down from 200 down to 100, what you need to be very clear about is what are the deals that you can add the most value to at your level? What are you really good at? What do you need to do? It might be 20 unit apartment buildings, turning them inside out and making them better. Maybe it's 50, but in C neighborhoods. I mean, guys like us who operate in the small world, the kind of the small business area, we have to add a lot of value. And if there isn't enough juice in the deal, that means that you're not adding enough value. And you need to be looking for deals where you're adding more value. I mean, that's what it sounds like to me. And maybe I'm right, maybe I'm not right. I don't know your deals. But if you're having trouble making your margins, you need to be adding more value to these deals. And if you're not adding enough value, then you need to find deals that need more value added.
And that's Joel, that's kind of the reason I bring up we went to our goals retreat in January and we talked about what's our pivot, right? Because we had our criteria written down. We're very strict about it and saying 100+ unit apartment complexes. And then it went to, we wanted the deals to be over $10 million. And I had to ask myself, like, okay, why? Like, why do we want it to be that? And it was because we wanted a focus so that we could get only these deals to look at and reduce the stray voltage. But what we're finding is that those deals aren't penciling out very well for us.
That's right. That's right. Those are not the deals. The market doesn't need a guy like you to develop those deals. Those deals are for guys that are a little bit more fine-tuned.
Yeah.
Guys like us are really good at squeezing value from broken deals, stuff that's broken. And that is a better focus with lots more juice. And you'll be able to deliver much better margins to your investors, much better margins to yourselves. And that's what you have to get focused on. So just randomly saying 100 units, I get why you want to have some focus, but that's not a profit formula that's going to last you into the future.
So it wasn't as random as it make it sound. It was like we were looking for class B and C value add opportunities, and we had like 3 major markets that we're looking at. So we did have a criteria, but what I'm saying now is, like, I think that criteria that we've been just arbitrarily sticking to is the wrong criteria, in my opinion. And that's what I talked about. 2022 for the real focus team needs to be the year that we pivot. And really what I found, I think I'm right on this, and my teammates do too, is pivoting into the smaller boutique hotels. And the reason I think that is just because, like we talked about, the institutional money has been a lot more curious at the lower level stuff, because there's a lot more money laying around, a lot less assets. So their criteria has opened up to less than 200 units. Let's go down to 100 and see, okay, even less than that in certain markets. And it really pushes out the guys who are chasing larger returns, because they're competing against the S&P. They're not competing against the individual syndication team who needs 12, 15% returns. They need 3 and 5% returns.
Listen, you're 100% right. And part of why I like the whole idea of these little hotels is not only because you can probably squeeze out good margin. I think you'll have an easier time raising capital because it's a unique deal, especially in parts of the country where those hotels exist, but also because there's a roll-up opportunity that, beside the fees that you get, beside the profit sharing you get, beside the cash flow the investors get, beside their upside that they get, they're going to get an extra bang when you sell the portfolio. There are guys that do this in the storage business, where they do roll-ups. They'll buy 1, 10, 15, 20 of these storage facilities, and they'll sell them as a basket, and they'll make oodles of money doing that. The other guys are doing mobile homes, mobile home parks, and they'll kind of roll them up, get them organized, kind of get some software going, get the whole thing straightened out, sell them as a package. What you're talking about lends itself to that exact same thing. I personally am very bullish on what you're describing.
I think that's a great point to bring up, because I usually look at like a roll-up, I guess from my education level, I look at it as like a portfolio deal. And whenever I'm looking at buying a portfolio, I'm looking for a discount. But what you're saying is people are like, no, I'm not looking for a discount. I'm looking for time saved.
Exactly.
To put this portfolio together.
Entrepreneurs look at it backwards of professional investors. Little guys look at saving. They think that volume, if you buy 2, you get a better price than you get 1. But when it takes time to put something together, large companies value time more than anything else. If you can save them time, they'll pay you double or triple to compensate you for the effort that you use to put the package together. because they don't have to do it, and they just step into a ready-made deal. It's like buying a cake that you just pour out of a box and it's ready to go in the oven in 10 seconds. You don't have to stand there and labor over it. It's worth an extra couple bucks to have the cake just be ready and all the ingredients are in one box. And if you can be the box, then you're going to get paid extra, a lot extra.
That's very interesting. I've never even looked at it from that concept. Thank you for saying that, by the way. Well, Joel, I think what we need to do next is move into the 3 questions that I ask all of my guests. And the first question I ask is, throughout all of your investing career, what was kind of the pivotal moment that you saw, or I say the turning point where you saw your success really start to take off? Like, what was it? A deal? Was it a mindset? Something that you did differently? What would you say it was? And why do you think it worked?
Well, probably the biggest thing that happened in my career, at least early on, was when I sold my company to that big company. I mean, that was big. And then I moved into venture capital and other kinds of transactions. I started getting involved in lots of other kinds of things. So that allowed me to be flexible and pivot into some other things, which was very, very cool. And I hope that kind of answered the question. I mean, that is kind of
makes sense. $10 million sellout. That'd be pretty pivotal.
Well, that we raised that much. I mean, it just so anyway, but it was a good deal. Yeah.
Okay. And then what would you say has been your biggest, not necessarily failure, but biggest mistake in your investing career?
Believe it or not, I consider the biggest mistake when I sold that company. I should have at that moment engaged PR to make me famous, because the mid 90s were when a lot of guys were doing these like internet deals. And I should have been one of those kind of guys. I should have been promoted as one of those people that would have accelerated a lot of what I do. I mean, I kind of got there slowly over time, but it would have rocketed me into a better position. So PR is a really important thing that I did not understand at that time and didn't take advantage of. And I wish I did.
Is it that your personal brand building is what you're talking about there?
Yeah, exactly. In other words, this guy just did this big deal, and here's how he did it, and go on TV shows and go on newspapers, and then people would call, and then investors would want to come because they want to get attached to that. It just, a lot of things would have happened in a bigger, better, faster way if I had gotten more famous early on.
What did you do? Did you just kind of like sell the deal and kind of start from scratch?
Then some guys found out about it. Remember, there wasn't social media. There wasn't LinkedIn. There wasn't anywhere to brag about what you did except for newspapers. And so it was the world kind of found out about it through whatever way it did. But, it was a small corner of the world. It was like a lot of people. So today it would have been a lot of people. Okay,
cool. The last question I ask is, what really bruises your bananas about the world of investing? It could be about real estate investing, whatever it is, but what's something that you see going on in the world today that you think is either wrong or you want to set the record straight? It's your time to kind of fling some poo.
It's a wonderful question. Probably the thing that disturbs me the most, because it's the worst advice, is when people go around talking about doing joint ventures. Okay, so you raise money from an investor, you get a private placement, there's a legal mechanism for raising money. The government doesn't especially like, by the way, when we take money from people, because sometimes money gets lost and then they got to put them on welfare, and they don't like doing that. So they've created these rules, are called securities rules, and that's what a private placement is based on. Well, a lot of people say, well, I don't really want to pay to have that done, so I'm going to kind of do a workaround. So you're the investor and I'm the promoter. And we're just going to call it a joint venture. We're just going to do a joint venture. You're going to put in the money and I'm going to do the real estate part. Now we're joint venture. And that's fine until something goes wrong. And then when something goes wrong, then the person that put in the money calls our attorney and says, yeah, I'm in this joint venture with this guy. He goes, oh, joint venture? What do you mean it's a joint venture? Well, we did the thing. I put in the money and he's doing the real estate. He's like, well, do you vote? No. Do you look at financial reports monthly? No. Do you do this? No. Well, this isn't a joint venture. This is a security deal. You should have had a private placement. So the bottom line is that it's almost impossible for a joint venture to be considered correct. Now, if your company and my company wants to do a joint venture, that's a real joint venture. That's where two companies do a short-term partnership and we do our project together. And then when the project's over, it's over and we go our way, we take our money. But very difficult for people to do a joint venture. Very, very difficult. And a lot of people end up, finding out that they should have had a private placement. They should have had all the legal stuff done. I see this happen all the time. And by the way, it's not just financial losses. Sometimes it ends up, with an orange jumpsuit too. So it's an unfortunate situation, and there's a lot of misinformation floating around about how this works. Bottom line is, attorneys are out there for a specific reason to give you advice. Do not take important advice from people who don't know what they're talking about, like people that just like go to your meetup groups and stuff. Be very, very careful. So that's a big one.
Awesome, Joel. Well, I appreciate you coming on, brother. This is your opportunity to plug anything that you got going on. I know you said you had something that our listeners could get for free. If you want to tell them how to get that, what it is.
Well, first of all, so we have our Syndication Hedge Fund Symposium that happens. We haven't done a live one in 2.5 years because of the pandemic. So it's going to be in Las Vegas from Sunday, May 1st until Wednesday, May 4th. We teach you the inside out of how syndication and funds work and get you kind of ready to roll that sort of stuff out. And again, we've probably taught more people how to do this, and we've kind of set more people up maybe than anybody has. But that's a big thing. If you want to know more about that, go to syndicatefast.com. And at the same time, by the way, that you go to syndicatefast.com, if you register at syndicatefast.com, you're also going to get access to our library of materials. We probably have the largest library of syndication and fund videos probably on this topic in the world. People writing questions to us. Hey, Joel, what's the difference between a syndication and a fund? What's the right amount for a pref? How often do we pay? And we've made over some years a bunch of videos that answer every one of these questions in Dear Abby style. So if people want it, if they want to learn about the symposium, if they want to learn about these videos, they can have them for free. Go to syndicatefast.com.
And if they text 72,000, the word asset, what happens when they do that?
Pretty much the same thing.
Okay.
Those are the same thing. So if they go to syndicatefast.com, then that'll make it happen. If they go to if they open their phone and they take the texting app, they put in the number 72,000, they put in the word asset, they're also going to get the same information. They'll get the access to the same videos.
Perfect, Joel. I appreciate you coming on, brother. Awesome guest. I hope you consider me in your network now, and I look forward to this episode posting, man.
Hey, well, listen, man, thank you very much, and call me for advice. I'm happy to help you.
Absolutely.
Thanks for listening to the Guerrilla State Investing Podcast, where we give you the ground-pounding truth about what it takes to be successful in real estate. Learn more at realfocus.org/Guerrilla State Pod.